Okay. I hear you ask. What are stock options and how did the investor bro lose $500,000 after only buying $1,000 worth of stock options? Well, I'm glad you asked. So, stock options essentially are insurance for a stock. You pick how to interact with the now price, but in the future. How does this work? Well, what are the two types of stock transactions that can take place? Buying and selling. As such, there are two types of options for each of these transactions: calls and puts. Calls are stock options that allow you to buy stocks in the future for the now price. How does that work? Well, the options writer, like any good insurance salesperson, makes you pay a premium to use his insurance policy. He then gives you the guarantee that you can buy the stock from him at the agreed price, known as the strike price. This contract allows you to exercise your option and buy the stock at the strike price in the future. So why do this? Well, if you purchase a normal stock, you can lose as much as that stock is worth. But with options contract, you only lose the premium you paid to the options holder. This is because you did not buy the stock, you bought the right to buy it at the strike price, which means you can just say, I don't want to buy it. As such, you see on this graph, the amount of money you can lose with options is only the premium you paid, while the amount of money that can be made is only the premium minus what you would have made if you just owned the stock regularly. This is true for the other type of option, puts. Puts operate in the exact same way, but instead of the right to buy a stock, you get the right to sell a stock. So if a stock falls in a price, you can buy it at the cheaper market price and sell it to the options salesman as a profit. This profit graph is for puts, just backwards calls. Side note, these contracts do expire. They are bound by time restrictions. For example, the options salesman can say he will exercise the option for only a year, or a month, or a week, or a day. That's something to think about when you buy it. That also means that you have to renew it by repaying him if you want to keep the insurance plan alive, like any good insurance. But who sells these options contracts? Well, you. You get to be the insurance man. As such, you get to write the contract. This means that you set the premium, the strike price, and the expiration date. This gives you all the power. Sounds nice, right? Well, nothing in finance is perfect. Take the graph of a call for a buyer. Now, the buyer makes a profit if the stock rises enough to cover the cost of his premium. Well, the seller makes money when you don't use your option. As such, his graph is flipped. This means that the seller makes far less money than he could lose. Essentially, he is taking a much riskier position. Why would he do this? Well, first off, profits are profits. Second off, there is no way in a normal economy to profit off of stocks maintaining their value. But there is with option selling. See, if the stock does not change much, then the option seller collects his premium and runs off, assuming the other guy does not exercise his option. Even if the buyer exercises his option, no money is lost since the stock price and the strike price are roughly the same. Still, the risk is certainly noticeable. For example, the seller graph for calls shows that the seller can lose an infinite amount of money. This is because if he needs to buy back a stock in an option contract and it has risen an insane amount, he still has to buy it at the expensive market price to sell it to the investor at the cheap price. So what can you do with this problem? Well, if the seller buys a stock at the cheaper price, then he no longer has to worry about this. As such, his profit graph switches to this. Now you see, we just combined a stock purchase with an option sale. This opens a whole new venture into combining options strategies. This is how they truly make money in large quantities. For example, the situation I described about earlier, combining a stock purchase with a call sale, is known as a covered call. This covers the infinite loss on selling a call option with a stock purchase. You can combine calls, puts, and stock purchases to do a myriad of things. For example, if you do not want to lose all your money on a stock but do not want to buy a call, you can buy a put option and own the stock simultaneously, making a protective put. This can get stupidly complicated if you work hard enough. For example, and get ready for this one. If you buy a put cheaper than market price at A that expires in 60 days, sell it cheaper than market price strike price B, it expires in 30 days, sell an out of the money or cheaper than market price call at price C that expires in 30 days, and buy an out of the money call at strike price D with an expiration date of 60 days and hope that the stock price fluctuates between price B and C, but not closer to 1, while still fluctuating since you bought the stock directly in the middle of B and C. To not ruin the setup and bias it towards either extreme, you can capitalize on the minimal fluctuations of a stock price in 60 days. Congratulations, you did it. Now, since you are just starting options trading since you are watching this video, this might be a little too hard for you to do right off the bat. However, it is indicative of one thing stock options are best at: predicting stock movements beyond up and down. Combining these option strategies allows you to guess with impeccable precision the price of stocks. However, since a lot of these strategies require masterful execution and understanding of markets, they are very inherently risky. Combine it with the fact that stock options are frequently done with leverage, meaning that the risk of these strategies is too numerous to amount. Still, if you feel confident in your strategies, go for it. There's nothing holding you back. In summary, options are contracts that allow you to cover the risks of stock transactions with insurance policies. If you feel as if a stock is going to rise but want to be sure, call options allow you to buy a stock at a current price while mitigating the potential risk if it falls. If you want to feel as if a stock is going to fall but want to be sure, puts allow you to mitigate that risk. However, Wall Street financial bros will literally do anything to make a couple extra cents. So they combine these strategies. This can be understandable, like covered calls, or wherever the heck this mess is. Ultimately, these combination strategies are used to pinpoint exact stock movements to a degree simply buying and selling cannot. Thanks for watching. Like, sub, empty the dishes, comment a question, stay in school, and peace.